Will investing in the Bajaj Allianz Life Invest Protect Gold Plan potentially offer you superior risk adjusted returns in the long term? Let us find out the answer to this question through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. So before analyzing this policy, let us first understand a few basic details about it. So this is an unit-linked insurance plan. Some of the key features of the policy are your loved ones get lump sum payout in your absence, and you can grow your savings corpus through market-linked returns, and they also return the charges to help boost your fund value, and there are loyalty additions and fund maintenance boosters available to enhance the maturity value of your fund, and riders also available to provide enhanced protection, and there are tax benefits as per the applicable laws, and there are benefits like death benefit, maturity benefit, loyalty advantage and loyalty additions. So if you want to know more about these aspects of the policy, you can refer to the policy brochure. So there are other portfolio strategies, and also they have varied fund options like equity growth fund 2, accelerator mid cap fund 2, pure stock fund 2, asset allocation fund 2, blue chip equity fund, bond fund, liquid fund, flexi cap fund, sustainable equity fund, small cap fund, mid cap index fund, dynamic asset allocation fund, small cap quality index fund, and individual short term debt fund. And in this tabular column, all these fund options are categorized based on the percentage of allocation each fund option has allocated to asset classes like equity, debt and money market, and also according to the risk profile each fund option has. This tabular column has categorized these fund options, so it's easy for your reference and understanding. And there are also various charges this policy imposes on the policyholder. So let's take a quick look at that. So they have charges like mortality charge for providing you with life cover, and fund management charge for managing your fund options, and also policy administration charge, premium allocation charge, miscellaneous charges, and also charges for discontinuance or even for surrender. So the thing is, ULIP products typically impose charges that are not present in other market related products. Charges such as discontinuance fees, policy administration charges, and premium allocation fees represents the overhead cost for investors, because in the long run what happens is these charges can erode your returns and ultimately diminish the overall profitability of your investment. Now let us take a look at the advantages and disadvantages of investing in this policy. Let's start with the advantages. You can change your portfolio strategy during the policy anniversary, and under the selectable portfolio strategy you can switch units between funds, and you can opt to change your prevailing premium payment frequency at the policy anniversary, and you can also increase the sum assured at any policy anniversary. So these are the advantages. However, the disadvantages are there is no loan facility available under this plan, and this plan does not offer any liquidity during the first 5 years of the policy term, and the return on charges is also not an attractive feature because they do not consider the time value of the money you invested. So the asset allocation under the fund options also looks similar, so the fund option seems to be repetitive. So these are some drawbacks that you need to keep in your mind and before deciding to invest in this policy. So now, as we have a basic understanding of this policy, let us move on to the analysis part of the video. So what we are going to do is we are going to assess the potential return of this policy, which offers investment opportunities in the market. So ideally, any market linked product should outperform inflation to give us better risk adjusted returns in the long term. So we are going to examine the risk adjusted return of this policy by conducting an IRR analysis, basically calculating the internal rate of return of this policy based on the benefit illustration given in the policy brochure and calculated according to their policy calculator. So let us assume for calculation purpose that a 40-year-old male purchases this policy for a sum assured of 93.5 lakhs. So the policy term and the premium paying term is 20 years, and annually he is going to pay a premium of 1.70 lakhs. So if he pays a premium for 20 years, he will get the fund value at maturity. So we are going to assume the rate of return at 4% and 8% to indicate the worst and best case this policy can perform at. These are just example returns, they are not guaranteed and they do not indicate the upper or lower limits of returns this policy can give. The actual returns will depend on various factors including the future policy performance. This is just for example purpose to show you how this policy can perform in both extremes. Because this is a market linked product, there is a risk. So that's why we are demonstrating both the scenarios. So in the 4% scenario, based on the policy calculator, the final fund value amounts to 40.90 lakhs with an IRR of 1.73%. So this is even less than the rate of return you can get from a savings bank account interest. And in the 8% scenario, which is basically the best case scenario, based on the policy calculator, here the final fund value reaches 62.66 lakhs with an IRR of 5.52%, which can be similar or not even that much comparable to a debt instrument return. So in both scenarios, the return falls short of the inflation rate, making it insufficient for goals fulfillment. So consequently, investing in this policy might not be the most suitable option for a better risk-adjusted return. So what we are going to do is, we are going to compare this policy return with other comparable market-linked products. To ensure a fair comparison, we are going to use the same metrics or similar metrics as outlined in the previous example. So in Bajaj policy, they combine life coverage with investment potential. We are going to invest in insurance and investments separately in this alternative strategy to see whether investment and insurance can perform efficiently in an isolation. So here for life cover purpose, we have opted for a pure term life insurance policy with a sum assured of 1 crore costing us 20,100 rupees annually for a premium payment term of 20-year term along with a 20-year policy term. So here you can save 1.49 lakhs compared to the Bajaj policy premium. So the saved amount could be redirected towards wealth accumulation purpose in an investment vehicle we have chosen. So for wealth accumulation, for in this example scenario, we have considered two investment avenues, the PPF account and the ELSS fund. So basically the PPF is a debt example, ELSS as it has equity in it, it is an equity example. This is to show you how debt and equity also gives you returns. So under the PPF account, the final maturity value after 20 years is 66.53 lakhs, resulting in an IRR of 6.03% when combined with the pure term life insurance policy. These are guaranteed risk-free, tax-free returns. So basically an IRR of 6.03% when compared to Bajaj policy is giving you better returns actually. And also on the other hand, ELSS redemptions are subjected to capital gains tax. So the final pre-tax maturity value after 20 years would be 1.20 crores, which reduces to 1.09 crores post-tax. So if you have any doubts regarding how the ELSS tax is calculated here, we do have a small tabular column presented on the screen for your reference, which you can pause and see. So the IRR for the pure term policy along with ELSS investment stands at 10.20%. In these alternative investments, the yield exceeds inflation, facilitating wealth accumulation and enabling the fulfillment of all financial goals. So opting for the Bajaj policy may result in a shortfall in the required corpus for your goals. So what is the final verdict then? Was investing in the Bajaj Allianz Life Invest Protect Gold plan worth it or not? Like any other ULIP plan, this policy provides you with life cover protection and a chance for market linked investment. However, the potential returns of this plan don't match up to those of other market linked products due to hefty charges and high agent commissions. So despite investing in the market through this plan, the returns generated are insufficient to outpace inflation. This defeats the purpose of investing in the market. Alternatively, for life cover, you could consider a pure term life insurance policy offering high coverage at an affordable premium. For wealth accumulation, building a diversified investment portfolio is advisable depending on your risk tolerance. You can select an appropriate product. Is it advisable to depend exclusively on platforms such as social media for financial guidance? No, it is not. So if you have any difficulties or doubts regarding how you should navigate your investment or financial journey, it's better you seek a professional guidance through certified financial planner.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.